What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves, 45 days, free, no risk, no friction, just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Welcome everybody to episode number 43 of the Sparta Market Outlook. I'm your host, Felipe Elink Schuurman, and today I'm joined by Neil. Hi Neil, how's everything?
All good, thank you.
And also James. Hi James, all good?
Yeah, very well, thanks. How you doing?
Good stuff. Yeah, all good, thanks. And last but not least, Phil, also from Vienna. Hi, Phil, how are you?
Good, thanks, good.
Okay, so a lot of exciting topics to discuss today. I would say maybe to start with a lot of supply risk. I would say that's the key discussion point to start with. As usual, Neil, maybe you want to kick off by giving us a rundown of, on the fundamental side, what are the main things that happened this week?
Yeah, we can go through them. So one of the ones that appeared over the weekend was Libya again. So there were headlines about the potential for force majeure on Libyan crude exports, which is basically geopolitically driven. It's the east-west infighting once again coming to the fore. It's worth a lot of volume potentially. In the past, sometimes you can get, maybe 500,000 barrels a day or more disrupted for several months. So it's a big deal, but it's a wait-and-see trade, let's say. Sort of crude diffs did respond. There's an argument to see that Brent spreads responded as well on the news. Seems to be calming down now, but it's just one of these things that continually rears its head, let's say. And the other thing to mention is wildfires. So following on from last week, John Coleman, of course, was on just talking about the risk of wildfires in Alberta. And lo and behold, the next day, we got the headline, and indeed, TI time spreads did spike even over and above Brent. So very good call there. At the moment, it's affecting about 500,000 barrels a day of marketable crude. That means sort of bitumen plus diluents, so it's substantial. And there's potentially more ahead, right? Because we're just starting the season. So that was a very good call from John on TI spreads. We can go into sort of where the next step for TI Brent might be later, but the last one is Iran, right? So I don't know about you guys, but I got the impression on the headlines the last few days that this deal is once again not looking particularly likely, right? So this morning, I think Iran rejected the US proposal. It's vowing to keep enriching uranium. Yeah, I don't know what the next move is, but I get the impression that's another risk that's spiking again.
Yeah, Trump is having a hard time signing all these big, beautiful deals that he was supposed to sign. Today he was talking about Xi Jinping and his ability to sign a deal with him was actually very complicated nowadays. We're not getting anywhere close with Russia. We're not. It's something to keep an eye on, because ultimately, what will happen if a guy that has been promising that he will do all these deals within 24 hours, and now or maybe a year, 2 years later, nothing happens? Are we going to see an escalation or not? It's a question mark there.
I mean, I just wanted to have another kind of discussion with you guys about the general state of the market as well. So we also made the call over the last few weeks that we wouldn't want to be short Brent spreads, for example. And sometimes we get these things wrong, but this time it turned out to be quite a good call. We said that at 20 cents backward, and now we're 60, 70. it seemed like a good call because it's the time of year where runs go to the max, margins are high, the OPEC story is overblown. We've talked about this 100 times. And the difference between real exports and official supply. No, there's now a question of what happens next, right? So how much of this is fundamentally driven? How much of this is, kind of market getting complacent about macro? Yeah, I mean, it's just my feeling is that it's partly fundamentally driven. It doesn't feel like the risk reward now for being long even further from here is very good. And sort of Brent spreads are kind of fair value, I would say, let's say just now. But there's a risk on both sides, right? There's supply risk and there's macro risk. And the one today, by the way, was there's a jobs report from the ADP, which is basically private sector hiring, which is a huge miss. It's the lowest level of hiring in 2 years. And those things get scary, right? Because you could very quickly turn the whole sentiment around with just a few of these headlines. Let's say the non-farm payrolls data on Friday shows some massive slowdown, then this whole discussion can turn very quickly, right? Is that fair?
I think it's fair. I think it's a fair comment that on the macro side, there's been a lot of the realities that everyone was, the big hedge funds and the bond market were telling one story of that is, not necessarily extremely bullish, but the stats were good. The employment stats, the growth, the tech companies publishing phenomenal results. And the employment numbers were phenomenal as well. So there was this sort of like something's going to happen, but it didn't really happen. So maybe it's a time gap or a delay, and we're starting to see that. I don't know. Let's see.
Yeah, I mean, it just feels like we're rolling on the same story, right? Because it's very tight at the prompt and the whole market is, just waiting to further sell the back end of the curve, even though we're already in contango. And it's just a question of like, when does this actually change at the prompt? And one thing I want to point out again, not to bang the drum continually, but I'm just posting a chart for you guys in our chat. That's US total commercial oil inventory, crude plus products. And we are now down 40 million barrels versus last year, right? It's basically counter seasonal almost. We're now down 40 million barrels. There's a big gap that opened up over the last 2 months versus last year. The thing looks tight, like the stocks data is tight. And when does this turn around? And maybe that's something that you can talk about, James, as well, with the outlook going forward for products, because I just don't, like for me, I just don't see fundamentally what's bearish about the prompt, except the huge macro risk for the headlines, basically.
Yeah, I think that's completely fair. I think, we were talking earlier this week about, all right, obviously there's a lot of bullish headlines out there. What is there out there to counter it? And you do keep seeing the agencies come out with their balances for the rest of the year and into next year, and they're all still extremely long. And we spoke about that 6 months ago, 9 months ago, about how 2025 was supposed to be, extremely long, and it hasn't materialized yet, clearly. Obviously in the US stocks, but also elsewhere in the kind of high frequency stocks and the Jody stuff, it hasn't really materialized yet. The question is, are we missing something, or are those agencies missing something, or do we have a big turning point coming in the next couple of months? But I wouldn't see where it's coming from other than, a potential demand slowdown, which we haven't really seen yet.
Yeah, well, for me on Distillate, and without giving away the punchline about what I'm going to talk about later, I can make a bearish case past the prompt. We've got low stocks now in the US and also some stats coming out about like Fajera, for example, distillate stocks. But when I think about that now, do I believe that distillate stocks will go further down from here? No, I don't. I think should be seeing increasing runs globally, helped by good refining margins, doubts about just seasonally reducing demand as we move in, distillate demand as we move into the summer in general, which should only be made worse about those kind of macro concerns about the economy over the summer as well. I can make a bearish case on distillate. I haven't got high conviction about it, but I think one can be made.
That seems to be the risk that is basically, that's partly predicated on a demand slowdown, right? Just to be clear, total distillates demand in the OECD rises from now until late summer, including jet. And so it's like partly balanced out by max runs. For me, the question is always, what's the trend versus last year or the average? Because there's always seasonality in stocks and things like that. But do we have evidence that we're rapidly building beyond what is seasonally normal? At the moment, the opposite has been the case. So I'm fully with you, James, that there might be a big turnaround. But first, I would like to see, from my perspective, much bigger builds in the US, for example, in terms of distillate stocks.
Yeah, it goes back to timing, right?
It goes back to
So,
timing. And the one
yeah.
thing I keep thinking, sorry to extend this conversation, but the one thing I keep thinking is that yes, there's macro risk, there's demand risk, but there's more supply risk than people appreciate, right? OPEC are not raising production really in the way that they say. And people are usually very complacent about spare capacity as well with OPEC. And then there's things like US rigs. US rigs are plummeting. And there's, okay, fine, we don't think there's going to be a huge contraction by the end of the year, but there could still be surprises on the level of US supply. And then there's a big chunk of non-OPEC supply, Guyana, Brazil, which is like all in Q3, Q4. And if you get some misses on those things, then you might end up at the end of the year with a completely different supply picture than people currently envision. And I think that's being underappreciated in the market just now. And there's a lot of focus on demand and OPEC instead of, okay, what, the sort of nuances of what the supply picture will look like later.
If I may, to summarize, this is a conversation we've been having for quite some time. Phil, you were mentioning it. We talked about this 6 months ago, etc. What I find interesting is, from what I hear, is that all this time we have been, to a certain extent, contrarian, with the caveat of diesel, where diesel was never the bull picture, but particularly on crude and sometimes gasoline and fuel oil, etc. We were not seeing those super negative signs that everyone was talking about, and we were just talking facts. The facts are that the stocks are not what everyone was implying, and etc. But from what I hear, Neil, you seem to be now at the position where, okay, the market has reacted, it has priced this risk, etc., and we're now on, at least on a spread basis, maybe not on a flat price basis, but on a spread basis, we are now at a point that is okay. Do I want to get long here? I want to be more wait and see, because all of those things can, come into play. This is the first sign with the ADP jobs. Again, macro, not really oil stocks, but it has to do with one of the sides, the demand side. But yeah, we have not seen that on the flat price. That's for sure. It's healthier, but it's not bullish, I would say. Is that a good summary?
Yeah, and I was just wondering about risk, like risk reward for things, right?
Yeah.
So the back end of the curve is already in contango. So are you saying you want to wait to sell further the back of the curve, or is there more reward in something like, well, maybe actually the end of the year will be tighter than we all think. Maybe there's a bit of risk reward in buying deferred spreads, I'm just sort of, it's not a very well formed thought at the moment, but I just think the supply picture might be different, very different to what people assume. And we've been talking about, we've been rolling the prompt tightness for months now, right? For 3-4 months, always the deferred picture is loose and the prompt is tight, and we just keep on going. And we've been saying this for 3 months.
Okay, so you maintain that theory, but it's just like how do you express that conviction is more, not so much on the front end of the curve, but more on the back end of the curve, where there is an opportunity there, and definitely on the front end we got to the point where it's been priced at this stage.
Yeah.
Okay. Let's look at let's continue. Let's dive in or unpack all of this, because ultimately this is the conclusion. Now let's go back to the elements that can drive that conclusion. So on a physical perspective, and staying with you, Neil, on the crude side. We've talked some general stories about crude, but is there anything in particular on the physical market that you want to share with us?
Yeah, let's just go quickly through it so you guys can talk as well and do your bits. I've been talking for a while, but I had quite a few general conversations about what's driving physical crude as well. And the one thing that looks interesting just now is the DFL again. So I have there's a definite feeling that the DFL is just pricing from one extreme to the other, and it's quite volatile just now, and at the moment it's extremely strong, particularly June, and it's difficult to imagine that is super fundamentally driven. It smacks more of a bull play just now, so that's one thing. But on the other hand, there are in terms of physical sort of global average physical diffs decent signs, right? So in Europe itself, Sverdrup is extremely strong. And generally speaking, the medium and sour crude market in terms of physical premiums has strengthened a lot since April. Does that smack of more OPEC supply? Not yet. And we're higher than last year's levels. And the same thing's happened on light sweets as well. So light sweets and medium sours in terms of global physical premiums are strengthening. Fine. So that's one thing. And yeah, the other thing just to say is yeah, I can see that that's fundamentally driven. Just looking at US crude stocks, for example, and we didn't really get a very strong building season, right? So I think that's fundamental. And yeah, this sort of now we're entering max run season. I think it's just a good time for crude strength, generally speaking. Yeah, the other thing was the Murban story this week.
I was going to ask you about that.
Yeah, so the story is that basically Murban will be fed back into Ruwais, the expense of Upper Zakum, which is a more medium sour type crude, on the back of feedstock optimization. And that sent some ripples through the market, let's say, and indeed Murban diffs did really spike higher this week, and Upper Zakum tanked. And yeah, we're just trying to think about what this really means. Probably this might go back and forth because it's basically an optimization problem in the refinery. But for now, what it means is that it increases the likelihood that TI will price into Asia because Murban's becoming more expensive. And that's an interesting time for that to happen because, as we've talked about already, the internal US crude market already looks tight. And TI just now is priced out of Asia and sort of average or not that cheap into Europe already. So it's an interesting time for us to basically take a chunk out of supply of the Eastern benchmark because you risk basically pricing TI back in at the wrong time, let's say.
How far away are we from that happening?
That should be already... in terms of the
ARB,
ARB.
the ARB differential, it's...
Yeah, we're still a bit away from that just now. It needs.
So it's more like something to keep an eye on as a potential bull spike situation. Yeah. If this Murban story continues, if you want, and and the tightness on Murban continues. Okay.
Yeah, yeah. And that's just a segue into talking about the TI generally as well. So just to give an update there, it is basically bullish for Cushing, this wildfire story. You can see it in the WCS diffs, in the Canadian diffs. You can see it in the Mars diff on the Gulf Coast. So the sour market looks like it's tightened. And the other thing that added bullish impetus to this was the Chevron story. So there's another supply risk for you. The Chevron license, if you remember, has now expired, wasn't renewed. And, that basically means Venezuela supply is at risk. And yeah, clearly TI is pricing fairly, if you like. It's not cheap in Europe, it's expensive in Asia, and it's attempting to reduce its exports for now. And that ultimately will also be bullish for the Brent market for the coming weeks. That's it, really, from me.
So I'm just coming back to, because you started with the conclusion and talking about prices and your calls and what do we do from here, because at 20 cents backwardation, you guys were convinced. Now at 70, not so much, but everything you're telling me, it seems that it's pretty much of a bull story here for crude. So why the lack of conviction then?
I don't have low conviction. I think I just think that, well, you can always ask the question, we've just rallied 50 cents in spreads. Is there much reward in being further long? I'm not sure. Like we're pricing in some of these things, right? I think the market's now realized that OPEC supply won't be all that high. It's realized that there's a high burn season. It's taken a couple of weeks for those headlines to filter through. We know that runs are high. Europe is already, like the DFL is already pretty strong. So Europe's already pricing pretty strong already. There's now awareness about wildfire risk. I don't know. I don't feel like I would say, okay, yeah, let's go spreads to 150 or something. I think I would just say, okay, maybe we stay here.
Okay.
Or buy dips, for example.
Yeah, no, that makes more sense. Okay. So basically the market has caught up with the story, and now we would need a strengthening of that story for the market to continue to rally, etc. So buy the dip kind of situation. Okay.
I think for now, yeah.
Yeah, understood. Moving on to light ends. So Phil, you were mentioning that EBOB barges are finally on the up. Are we seeing the start of a summer strength here, or what's the story?
Yeah, so there's a couple of indicators or a couple of price points that you can look at and say, oh, or maybe we're starting to see this summer strength that we've been talking about being missing for the last kind of couple of months. So EVOB barges, as we said, they're trading at kind of double digit premium territories for early June, which has not been the case for a long time now. Last week saw Pad 1 have a decent inventory draw on low imports, so kind of helping to tighten the overall kind of Atlantic Basin picture a little bit. We also had news from BP Rotterdam that the second CDU went down a few days ago. And so there's a decent amount of pricing center located supply also now missing. Gas naps moved to $140 a ton. That's kind of a $20 gain in the last month. So we're starting to get kind of closer back to those levels from the last couple of years. The referment premiums that we've been talking about since February finally ticked up. So that the chart that has just been a kind of gradual downward slope ever since February or March actually kicked off the bottom, not by much, but there was some life there. And finally, the inventories. So the weekly kind of ARA inventories have continued to draw. So they're finally back in line with recent years. And that kind of might point to finally clearing that overhang that we were talking about all the summer grade and the referment that was been in storage since January, February.
Okay, all of this sounds extremely supportive, but I'm sensing a but coming into the story. Your latest commentary mentioned the other indicators putting a bit of a ceiling on the upside, and I see that the spreads haven't exactly impressed yet. So what's the but here?
Yeah, so you're right. With all of that news, July-August spreads are down about $1.50 to $2 over the last week or so. EBOB spreads, that is. RBOB spreads have also come off a similar amount. So we mentioned kind of referment premium are a little bit up, but alkylate, MTBE, the FCC naphtha premiums, they're all still very low. They haven't really seen any kind of movement. And despite gas nap widening, the naphtha premiums as well, so that the OSNs and the M+As have not seen any kind of significant increase there. So no real show outside of that little uptick in reference from the component premiums, at least, that we've got any strength there. As I mentioned, kind of that's counter to this continued gradual uptick in gas nap spreads. So reference hasn't really followed, and then the OSN and the M+A, which you would expect if there was that kind of increased appetite on a wider paper gas nap to blend more naphtha into the grades in ARA, you'd expect them to maybe pick up, but we haven't really seen that. So those stronger EBOB barge diffs that we were talking about haven't filtered into the EBOB spreads, and the lower PAD 1 inventories that I mentioned actually, it's a relatively sizable drop, but it really just brings them back into line with where they were this time last year. Obviously, it's been trending above 2024 so far this year, at least since February or so, and now we're back in line with where we were last year, which itself was anyway at the top end of that kind of 3-year post-pandemic range. So yes, we are now kind of well below the pre-pandemic averages, but it seems as though that PAD 1 market is happy at the moment running on those kind of relatively low inventories than they were seeing pre-pandemic, despite lower nameplate refinery capacity in PAD 1. And so with all of that, the lack of RBOB response, the lack of response on the RBOB side from this downtick in the PAD 1 inventories meant that the TA ARB is increasingly difficult to work. So RBOB out of ARA moving across the Atlantic, and so that's even making in our ARB tool our second row, the ARA refinery assessment, which has kind of a 3 cent per gallon advantage over the blender on a blend stock basis. Even that has been struggling to be really in the money the last couple of days. And if you combine that with apparently wholesale WAF prices being lower than delivered costs out of ARA, PAD 3 looks very strong in terms of builds and weak component diffs. So all of those LATAM ARBs are pointing to US Gulf rather than ARA. It just means that for an ARA gasoline blender or refiner, the ARBs out are closed. The E10 blend margin's just about open still, but all the ARBs are closed. So it seems kind of difficult, I suppose, to justify any real continued strength or even any real kind of summer uptick now just on the basis of a couple of bits of news when actually all the ARBs are still closed.
Okay. Yeah, so a lot to unpack. It does seem, from what you're saying, that seems that we are on the higher side of a range-bound type market where there's no strong direction, and gas naphtha moving up by $20, but that's something that can happen in one day, and then the next 1 week later it goes back. So there's nothing really. There's no story here.
Yeah, I've talked for a while to come to a conclusion that
this is like when
traders and brokers that we've been talking to for the last couple of months keep on mentioning that they're looking for a piece of news, right? That they're looking for some kind of catalyst They need something to kickstart summer, and thought maybe it could have been BP going down and some strength in the barge market. But I think there's still too many factors keeping that pretty tight ceiling on spreads for now.
You got everyone excited with your beginning of summer. Here we go, and then no, sorry.
The only caveat, and I mean the bit that's been slightly more difficult to explain is that the East has been really strengthening. So Sing 92 spreads have really rocketed. That has brought the East-West up with it, and it's kind of eliminated that pressure that we might have otherwise maybe expected to start materializing in terms of arbs from the East into the Atlantic Basin for now.
Yeah.
That being said, like if we look at the East on its own, we would have expected actually with high margins, high refinery margins, and a kind of return from maintenance that the supply is supposedly picking up in the East of Suez as well now. So kind of also a little bit pessimistic on further Eastern strength, and maybe even later in the summer we see those arbs from the East challenging back into the Atlantic Basin again.
Well, let's see. I mean, there was this whole story about Indonesia that turned out to be that tender actually never materialized or was not awarded, if I understand correctly.
Yeah, not yet. It's gone to kind of a second private round. Yeah.
Well, they saw the prices and they got depressed. So I'm pretty sure that they're like, okay, it's a famous quote from this comedian Marx, Groucho Marx. Like, these are my values. If you don't like them, I have others. So it's. We stand behind, not getting any supply from Singapore. Oh shit, the prices are not exactly what I expected. Let's change our minds, So I don't know. Let's see. That's maybe, at least
it has to go back to the policy people. Yeah.
Exactly. That's generally the impression I got by, I spoke to a couple of AG gasoline traders and Singapore traders, and that's sort of the consensus was that nothing really will come out of this, or we'll see. And well. I mean, that obviously had a negative impact on the market. It's like, buy the rumor and, in this case, the other way around, sell the rumor and then buy the fact. But the reality is that, let's not forget what happened at the beginning of the year with all the Chinese export quotas, that they were quite dramatically reduced. We don't talk about it that much right now, but it's an ongoing situation. Maybe it's worth looking at the export stats and how they are. I don't know. Maybe something has changed. We haven't talked about it in a long time, but ultimately, that has a dramatic impact.
It's true, but they're also the Chinese players or the policymakers there are also quite responsive to the market. And so long as with gasoline cracks where they are now in the East, they should have good export margins. So if there's money to be made there, there's no reason why those quotas can't suddenly come up in the next round.
True. Let's keep an eye on that. But it's something that we haven't talked about in a while. Maybe you want to check it out with June, and we can pick it up next week.
Certainly.
Moving on to naphtha, you were talking about, gas naphtha and, what's happening there.
Yeah, so in naphtha, I'll admit I have talking points from Jorge here, so thank you to him. The time spreads, they're showing a bit of a mixed bag. Both cracks and spreads have seen a bit of a correction recently, so they've been coming off in the prompt, certainly, although slightly kind of opposite to what we've seen in crude markets. There's a bit more support further down the curve, and that's potentially because the eastbound arbitrage that kind of improves on healthy Asian demand, or expectations of it, is better in Q3 than it is in the very prompt. So the very prompt is kind of correcting on the basis of arbs that don't quite work right now, but once we start looking into kind of July, August, they do look better, and that seems to be helping kind of form at least a floor under spreads and cracks from kind of Q3 onwards. Elsewhere, so there's new facilities from Exxon, Wanhua, and Lotte helping to keep naphtha demand strong. So now that we're out of peak kind of Q2 steam cracker turnarounds in Asia, there seems to be at least a good kind of fundamental floor for naphtha demand in the East, especially with propane prices where they are at the moment. So the arbitrage, when we look at it in the platform, on an LR2 from the Med to Asia through the Suez has been open for a little while now, and it's been kind of almost workable via the Cape. It's now definitely open around the Cape for the first time since April. So that seems to have been kind of picked up, and that's for kind of July loaders onwards specifically. And that seems to have been noted essentially. And it looks as though just from a little bit of ship tracking that we've seen that some of those Med origin LR2s are now heading around the Cape. So I think in summary, it looks as though kind of the next few weeks should start to bring in some of that support to the prompt, essentially. So time spreads finding a bottom. And so long as this expectation for healthier demand in Asia, which is on the basis of decent steam cracking margins apparently, materializes, that should help kind of bring the whole naphtha complex a little bit, at least following its correction of the last couple of weeks.
Okay, well, thanks for that. Moving on to distillates. James, good to have you back. It's been a while. Before we start talking about the future, maybe you want to remind us on your, I think you last spoke about distillates like a couple of weeks ago. Yes. What were the calls at the time and what has happened? And again, as we like to tap ourselves in the back when we do it right, but we also want to be honest with ourselves. And if we got it wrong, let's see why we got it wrong. I don't know. Did you get it right? Did you get it wrong? And what should we see?
Yeah, no problem. Yeah, I went back and listened to the last time I was on the pod. I think it was May 14th. And so, yeah, the general view I expressed was I was long Western to get long Western June spreads, so ice gas oil, heating oil, short Singapore diesel spreads. And I guess I also thought that you could express this view by selling the East-West as well. And most of those have turned out to be correct. Although Singapore diesel spreads have corrected upwards over the last 3 or 4 days, as it were. The one part of that I think that I got substantially wrong was the call on the weakness in heating oil, the strength in heating oil spreads even. These haven't followed ice gas oil. Actually, they've come off since I was last on the pod. And it's actually quite surprising. It's one of the things that kind of given me doubts for kind of my more medium-term views is that these have come off heating oil spreads, even as US diesel stocks have headed towards the lowest level for like the last 8 years or so. They're like currently now 16 million barrels below where they were, 16 million barrels below where they were in 2024 at this same period. And again, just to say, I think this is one of the biggest things that's putting a doubt in my mind about my kind of medium-term view I'm going to move on to later.
Okay, so interesting. How so? I mean, what could you try to link this to a normal kind of discussion on the global distillate flows? What's in the back of your mind?
Yeah, so that's like a little bit of context before I move on to that view that's informed by the low diesel stocks now. So we've had a real narrowing of the gas oil east-west for pretty much the entirety of April. And this led to a lot of diesel exports from the Middle East, essentially AG, West Coast India, heading east, especially Indian diesel cargoes, which arrived in like record numbers for the last 4 years into Singapore, and explains that weakness that we saw in Singapore diesel spreads that we just allured to. And also because there was less flow, therefore arriving into June in Europe of diesel, also explains the strength that we predicted in June ice gas oil spreads, which I expect to continue until expiry, essentially. And that's kind of a bit of a surprising move, actually, because May ice gas oil spreads actually went out in contango. But since then, the gas oil east-west has actually widened reasonably dramatically, so pretty much for the entirety of May. And as such, I think we should expect increased diesel imports from the Middle East into Europe for July arrival. In a similar fashion, we've also seen then the HOGO widen for almost the entirety of March, April, and the beginning of May. And that again speaks and is a consequence of the reduced US diesel stocks that we discussed earlier. However, now since probably at the middle of May, we've seen this HOGO widening reverse. It's actually been narrowing ever since. So in a similar way to what I just expressed for Middle Eastern diesel cargoes, the US Gulf diesel arb has moved close to open. It's still marginally closed. But because of the weakness in Brazilian diesel premia, these cargoes, US Gulf diesel cargoes, should point at Europe over Latin America now. Well, I think we're going to continue to see this narrowing of the HOGO. That's a contentious call, I think. But in the same way as the Middle Eastern cargoes, I expect that we're going to see an increase in US origin diesel cargoes in July as well. So those are kind of like the two really important points that I want to come back and speak to again. So, well, let's just highlight it now. Reduced more imports from the US and Asia into Europe in July in comparison to June. That's my medium-term bearish view that informs it. But again, and I don't want to repeat myself on this, but the low diesel stocks that we're seeing in the US currently, globally for the US, but also for PAD 1, and also the low diesel stocks, middle distillate stocks that we're seeing in Fujairah as a sign of that stocks in the AG, does give me quite some pause for thought. It's true that now we've got strong refining margins globally and in the US, so we should see crude runs continue to improve from here, and with it, as a consequence, and globally, diesel stocks increase from here. And US diesel demand should decrease globally seasonally from here as well. And also, that allied with that is also kind of like fears about the economy as well. For example, even though US diesel stocks are below 2024, also US diesel demand is also below 2024 as well, currently as well. But again, with these low diesel stocks in the US, even if they build quite substantially, perhaps there's some doubts about the amount they will be able to export and therefore exert weakness on ice gas oil.
Fair enough. Thanks for that. And what about jet? Do you have the same kind of doubts on the jet market?
I have a stronger view on jet. I think the weakness that we've seen in jet over the last period of time, so for example, we've seen Northwest European CIF differential spreads cracks come off on jet over the last period of time. We've seen Singapore jet spreads move into contango in the prompt over the last week or so, although I think they've just rebounded a little bit over the last few days. We've got still Middle Eastern jet cargo exports pointing west into US and Europe and also open still. Allied with this, we've got record high jet yields in the US and rapidly increasing jet stocks there as well. And even though US and European jet demand has moved to levels above pre-COVID levels, Asian OECD demand levels are still kind of drooping below pre-COVID levels. So I have an overall weak view still on jet.
How do you conclude this situation?
Yeah, so let me really summarize it really well. So on the jet side of the equation, I think my view is clear. I think we should expect continuing weakness in the jet markets into the medium term. High yields, open arbs, strong but not extraordinary demand. An important caveat there should be said that generally, like global OECD jet demand tends to increase into July and August from here. So that'll be something important to monitor as well. Although I guess my view is that with the fears about the economy, we should probably see lower passenger numbers this summer than we did last, for example. On diesel, I think my view is more nuanced and a little less certain. So for me, just to get the context again, we had low diesel imports into Europe for June arrivals, explaining the strength in June ice gas oil that I expect to continue until expiry. I think it's next Wednesday. But from there on out, I expect we'll see, and I think the US diesel picture will be important to monitor, but I think improving runs globally, also helped by strong refining margins, somewhat reducing demand seasonally in the US and also due to economic issues as well, leads me to a bearish view. I think it's a tough call, but I would be looking to sell July-based diesel pricing from here. July-August spreads, etc. July-August cracks. But again, those low diesel stocks I think are important to monitor. And also the news we saw today about kind of low Baltic diesel exports is also another, Russian exports is another important caveat to mention. Thank you.
Understood. Okay, well, I think this wraps it up, unless you guys have any final thoughts that you want to share.
All good here. I'm less bearish on diesel. I guess I would say that. I think it's too early. Unless there's something.
Yeah, no, I think it's a tough call to make. Yes.
There's something that's keeping diesel stocks low. And it's something that we don't necessarily have an answer for just now, but it could be the combination of things like, we did have 500,000 barrels a day of US and European capacity go down now, shut off, mothballed. Maybe that makes a difference. And maybe that, justifies having some ARB from the East over the next month. We talked about Indian exports seasonally actually drop to the lowest point of the year over the next 8 weeks, right?
July,
so,
sure. Yeah.
So there could be, that the ARBs actually start to point a little bit more west, but the flow is maybe not quite so, interesting from that perspective temporarily. I don't know. I agree with all your statements about macro, and at some stage this thing might come off, but I'm looking at sort of July-August spread of +4 for ice gas oil, and I don't see that as, I don't know. There's something that I'm missing here. Maybe I just feel like we're still at low stocks. Maybe once we see that, US stocks are rapidly rising again, I start to agree.
Yeah, I think probably the EIA stats today will be quite important actually to monitor. Yeah, I think it's a hard one to call. And I guess it's kind of mostly on when it's deferred spreads. It's like, if I had to make a call, which I guess is the point of this podcast, I do think that generally global diesel stocks will increase from here rather than reduce. And therefore that leads me to be bearish. That's kind of the most important view.
Very good. Well, thanks, guys. This has been a great conversation. Appreciate all the insights. And once again, to the listeners, if there are specific topics, products that you would like for us to discuss about, or if you want to be part of the pod, or you want to join and share your thoughts, do not hesitate to contact us, put in a comment on LinkedIn, etc. And we'll be happy to have you and discuss the topics that you want to have. So thanks a lot, guys. Good to see you, and I'll see you next week.
Thanks very much.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.